Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about the UK economy. The official data has now been released for the final quarter of 2023, and it shows that GDP fell by 0.3% and that the UK has now recorded 2 consecutive quarters of negative GDP growth, which is the official definition of a recession. The UK is now officially in recession. And this is interesting because it comes out on the same day that Japan has also been recorded as officially going into recession. And interestingly, Japan has now lost its position as the third largest economy in the world behind the USA and China. It's been overtaken by Germany, which also is in recession. So we've got a really interesting set of data coming out for some of the biggest economies in the world. We've got Japan in recession, we've got Germany in recession, and we've got the UK in recession. So that's 3 of the 6 largest economies in the world. And in today's video, I want to dive into the detail as to what's going on in the UK. If you've been following the channel, you'll know that I've posted a number of videos on the UK. So it's not a surprise that it's gone into recession. We've been waiting for the official data for the fourth quarter of 2023. And the reason that the UK has gone into recession is multiple. Firstly, it's got to do with inflation. Inflation was running at very high rates around a year ago, and it's taken a long period of time to get that inflation anywhere near to the target rate of 2%. There's also been a problem with fuel inflation and energy costs, which have gone up dramatically in the UK over the last 18 months. And that's put a lot of pressure onto households and onto businesses. And on top of all of the price issues, the Bank of England has introduced 14 consecutive interest rate rises. And the rate of interest increased from 0.1% to the current level of 5.25%. And that has proved to be an absolute disaster for a lot of companies and individuals who took on a lot of debt over the last few years. So in today's video, we'll take a detailed look at what's been happening with GDP. We'll then go on to look at what's happened with inflation and interest rates. We'll take a look at what's going on with retail sales because they're a really good barometer as to what's happening in the economy, what your own consumers are doing. Are they increasing their spending or not? We'll then have a look at the balance of trade and the current account. And finally today, I'll wrap up with my summary. So what I think is going on in the UK right now, what's caused this recession and how long it's likely to last. Is this going to be a short-lived recession or will it persist throughout the whole of 2024? But before we get into all of that, once again, I'd like to say thank you so much to everyone that's supporting the channel. If you bought me a coffee, sent me a YouTube super thanks, or signed up as a Patreon or a member, thank you so much. You're really helping to support the channel and keep everything going, so I really appreciate it. This chart shows the 12-month rolling GDP figure for the UK, shown on a quarterly basis, dating back to the start of 2021. And what this shows is that the UK economy has been struggling severely over the last 2 years. In the first quarter of 2022, the UK recorded positive growth of 0.5%. However, since that time, it hasn't achieved anything more than 0.2%. And in 3 of the last 6 quarters, it's actually shown negative growth, so it's been falling. And if we look at the last 3 quarters, you can see that in Q2 of 2023, the UK recorded 0% growth, so it was entirely flat. In the third quarter of 2023, the economy fell by 0.1%, so GDP was reducing. And in the fourth quarter of 2023, the GDP figure fell by 0.3%. And the definition of a recession is when you have 2 consecutive quarters of falling GDP. And that's exactly what the UK has recorded now. It fell by 0.1% in the third quarter and a further 0.3% in the fourth quarter. So the UK is now officially in recession. And if we have a look at this chart, which shows the GDP figures on a monthly basis, you can see why economists are getting very concerned. Because out of the past 6 months, the UK has only recorded positive growth in 1 month, in November. And in July and October, it recorded negative growth of 0.5%, which for an economy like the UK is highly concerning. And I think one of the interesting things to note here is that the official figures that were originally published for October by the Office of National Statistics showed that GDP was down by 0.3%. However, they have now revised that figure downwards by a further 0.2% to 0.5%. So the actual detailed figures are coming in worse than the original expectations. And I think that's the overriding theme here, is that the figures that we're seeing on a quarterly basis are coming in lower than expectations. So the UK is doing worse than everybody thought it was doing. And if that continues, obviously it represents seriously bad news for 2024. This chart shows the movement in the official rate of inflation for the UK over the last 12 months. And as you can see, this time last year, inflation was in double digits. It was running above 10%. And despite 14 consecutive interest rate increases that were introduced by the Bank of England, it took a long time for inflation to come down to the current level of 4%. And these high rates of inflation are one of the reasons why the UK is now in recession, because those constantly high prices started eating into everybody's budgets, and so a lot of consumers in the UK started spending less. And when you get into those sort of cycles where people are watching what they're spending, they're not spending as much on discretionary items, they're focusing in on things that they really need to buy, like food and energy. That means that you have an overall reduction in general spending, and when you move into one of those cycles, a recession quite often follows. Now, when you take a step back and look at this chart, it looks very positive because the clear trend here is downwards. Inflation has been coming down over the last 12 months. But if we focus in on what's been happening over the last 4 months, inflation fell in October from 6.7% in the previous month to 4.6%, which was seen as being a huge step forward and a major improvement in terms of the way things were going. And there was expectations that the UK would potentially start cutting interest rates once inflation got down to the desired level of 2%. However, in November, inflation only fell to 3.9%. And then rose again in December to 4%, and it's remained at 4% in January. Now, the target rate of inflation in the UK has always been 2%. That is what the Bank of England is laser focused on. And 4% is obviously double 2%. So although when you look at this trend, it does represent positive news, the UK has managed to get its inflation down, it's still double the rate that the Bank of England is targeting. And what that means is that whilst inflation remains at around 4%, the Bank of England is not going to cut interest rates. It wants inflation to come down further. So therefore, the Bank of England is happy to continue restricting spending in order to hit its inflation target. But the knock-on implication for the economy is that the restriction on spending is causing GDP to fall. So we've got a real problem here, because when you've got one target, it can influence lots of other things in the economy. And that's one of the reasons why the UK is now in recession. Now, as you know, one of the metrics that I always like to look at is what's happening with food inflation, because the price of food impacts on the poorest members of society because they're spending a larger percentage of their monthly budget on food. And as you can see, over the last 12 months, things have improved in the UK. This time last year, food inflation was running at 18%. It's now down to 6.9%, so that represents a huge step forward. However, 6.9% food inflation still means that year on year, food prices have risen by almost 7%. Just because we've got a declining trend here, it doesn't mean that prices are falling. They're still going up. They're not going up as much as they were this time last year. But at 6.9%, it's still almost 50% higher than general inflation. So that means that proportionately, food prices are rising at a faster rate than general prices. So it still represents a problem. And in the same way as we've just discussed for general inflation, whilst food inflation is sitting at 6.9%, the Bank of England will still want to restrict spending to try to bring that back under control, to get that at around 2%. And whilst that's continuing, it's likely to depress spending, and therefore this recession situation is likely to persist. This chart shows the movement in the official rate of interest in the UK over the last 5 years. And what this shows is that throughout 2019, 2020 and 2021, interest rates were at record low levels in the UK. And one of the problems that created was that the cost of borrowing was so low that people started taking on more debt. And at the same time as the cost of borrowing fell, we had the COVID-19 pandemic, which meant that working from home became an established practice, and people realised that they could afford to move further away from where they worked because they didn't have to go into the office 5 days a week. And a lot of people moved house and took on the maximum amount of debt that they could. They were borrowing huge amounts of money because it was extremely cheap to do it. So it was very affordable. You could afford to pay the monthly rate. However, as you can see from the right-hand side of this graph, there were 14 consecutive interest rate increases in 2022 and 2023, and the official rate of interest rose from 0.1% to the current level of 5.25%. And the problem that's created in the UK is twofold. Firstly, anybody that wants to borrow money today is having to pay a hugely inflated price compared to what the prices were 2 or 3 years ago. And secondly, all of those people who took on the huge amounts of debt over 2019, 2020 and 2021, a lot of them are coming to the end of their initial fixed rate period, because in the UK, when people take out mortgages, generally speaking, they only have a fixed rate for either 2 years or 5 years. So all of the people who took a 2-year rate are now having to refinance at rates that are 4 or 5 or 6 or 7 times higher than they were when they originally took the deal out. And because a lot of people maximise the amount of debt that they could borrow, they're now finding that they can't afford to keep making those payments if the rates are going up so significantly. And this is now causing a lot of consumers stress and problems, and they are now having to cut back on expenditure across other areas of the economy to try to afford to pay their mortgages. So this rapid increase in interest rates, which was introduced by the Bank of England in order to try to bring inflation back down to the desired level of 2%, is having a hugely negative knock-on impact to the rest of the economy, because all the people who took on all of that debt are now panicking about the fact that they can't afford to keep paying it and that they could lose their house. And of course, the other factor to take into account is that there are a lot of companies in the UK that also have large amounts of debt. And they've also seen a huge increase in the cost of that debt over the last 2 years. And that's meaning that those companies have less cash flow and are therefore now investing less back into their businesses. They're hiring less people because they don't have as much cash to be able to expand. And this is also having a negative impact on the economy and is one of the reasons why the UK is now in recession. This chart shows the movement in UK retail sales over the last 12 months, and retail sales are a really good barometer as to what's happening in the economy, because when people are feeling affluent, when they're happy and they've got lots of money, generally speaking, they will go out and buy things and spend money, and so retail sales tend to go up at times when everybody's doing well. However, when times are hard and people are struggling and they haven't got enough money to do everything they want to, then retail sales tend to suffer. It's one of the first things that you cut back on. You decide that you don't need a new coat, you don't need a new outfit, you're not going to go out for dinner, you're not going to do all of the things that you would do when you're feeling happy and you've got lots of money. And what we can see from this chart is that over the last 12 months, retail sales have been in negative territory in 11 out of those 12 months. And there's only been 1 month, which was November, when the UK saw an increase, and that was 0.2%. And if we look at what's happened over the last 6 months, in July, retail sales were down 3.3%. August, they were down 1.3%. September, down 1.4%. October, which is one of the months building up towards Christmas, they were down 2.6%. There was a slight recovery in November. And in December, which is the absolute critical month for many retailers in the UK, year-on-year sales were down by 2.4%. And this really is a reflection of the issues that we've just been discussing. As we saw from the inflation data, prices are continuing to rise in the UK. The rate of inflation is coming down, but prices are still going up. And at the same time as that's happening, interest rates have also gone up significantly. And both of those factors mean that in real terms, UK consumers have less disposable income to spend, and as a result of that, they are spending less, and this is shown in the retail figures. And this is going to be a problem for the UK in terms of getting itself out of recovery, because it needs its own consumers to start spending to try to build the economy back up. If you've got strong demand in your home market, that is a very good base. If you've got weak demand, it's really difficult to stay in control of your own economy, because if your consumers are not going out and investing money and spending at the tills and putting that money into companies' bank accounts, the government will then be forced to implement stimulus measures to try to get the economy kick-started. And the problem with that is that it tends to drive up prices and inflation. So we've got conflicting messages coming through from the UK economy. And until retail sales start to go up again, the UK is going to struggle to get itself out of this recession. This chart shows the movement in the balance of trade for the UK over the last 12 months. And the balance of trade is basically the difference between the value of all of your exports and the cost of all of your imports. So basically, are you making money on a net basis or are you losing money? And what this chart shows is that the balance of trade has been in negative territory in every single one of the last 12 months, which means that the UK is now a net importer. It's buying in more things than it's making money from selling, and therefore that is costing the UK money. And this chart shows the quarterly movement in the UK current account, which is basically the UK's checking account, the bank account for the country. And what this shows is that over the last 3 years, the UK's current account has been in negative territory for the vast majority of the time. And that means that the UK is running down its reserves, and this is putting even more pressure on the UK economy. And the quicker that it can get itself out of recession, the quicker it can then get the current account back into positive territory and start building up some reserves again. So this is an absolutely critical issue that the UK needs to sort out as soon as possible. So what's the summary and conclusion today? Well, I wanted to post this video because I think it's really big news that both the UK and Japan are officially now in recession at the same time. Two of the biggest economies in the world are now currently struggling. And as we've looked at in today's video, there are multiple factors that have driven the UK into recession. We started off by looking at what happened with inflation. And this time last year, inflation was running in double digits. And that was general inflation. But when you dig down and have a look at what was happening under the surface, two areas of the economy that were hardest hit were energy prices and food prices. They were hugely into double digits. And of course, those prices affect everybody. They're not discretionary items. You can't suddenly decide to stop buying food or energy. You need both of them to survive. So these are basic costs of living for everybody. So that impacted on absolutely everybody in society and also impacted on companies. A lot of companies use a lot of energy. And the fact that those prices stayed so high for so long really had a damaging impact on the economy in the UK. And of course, the one thing that I haven't mentioned at all yet in today's video is Brexit. Back in 2016, the UK decided that it wanted to leave the European Union, and it took a very long period of time to try to negotiate some sort of deal to get that exit to happen. Now, that exit happened around 2 years ago, and the UK is still suffering problems as a result of it, because what it meant was that all of the relationships that it had with its European partners, who are the closest in proximity to the UK, were all cancelled. And the UK then had to start negotiating new deals. And of course, all of those deals were worse for the UK because the previous arrangement was a tax-free agreement. That's what being part of the European Union meant. However, once the UK left the European Union, all of those prices went up, and it's been very difficult for the UK to try to get prices back under control. So the knock-on impact of all of the things that we've talked about in today's video has led the UK to fall into recession. But the big question is, how quickly will it be able to come out of recession? And the answer to that is it's unlikely to come out at any point in the near future because, as we looked at, inflation is still double the target rate that the Bank of England has set of 2%. And until it gets inflation down to 2%, the Bank of England doesn't want to start cutting interest rates. And the fact that interest rates are sitting at 5.25% is hurting a lot of businesses and a lot of people. And over the course of the next 3 to 6 months, that situation is going to continue getting worse because more and more people are seeing their mortgages coming off their 2-year fixed rates, and they're having to remortgage at rates that are 3 or 4 or 5 times higher. And that's just simply unaffordable for a lot of people. So they're now having to make some serious decisions as to what they spend their money on. So we've seen a reduction in people booking holidays and buying new cars and just generally spending less at the tills. And until that situation reverses itself, the UK is going to struggle to get out of recession. So the Bank of England really needs to cut interest rates to stimulate the economy. But if it did that, inflation would start going up again. And that is the Bank of England's #1 target. So what we're seeing is the laser focus on inflation is actually damaging the overall UK economy. Now, the UK has a general election coming up later this year, and it's very likely that there will be a change of power because at times like this, when we have a recession and people are generally unhappy about what's happening in the economy, when there's an election, they tend to vote with their feet and decide that they want to go with a different party. So it's possible that there will be a change of government in the UK later this year. And until that happens, I don't think we will see this recession sorting itself out because it's likely that the economy will stay in the doldrums. Nobody's going to want to take any radical action at a time when there's a general election coming up. They want to protect their own positions. The turkeys don't want to vote for Christmas. So it's likely that we will see a continuation of the current policies being left in place. We may even see some tax cuts. That's what's being talked about in terms of trying to romance the voters to get them to vote for the Conservatives. And if that happens, obviously the UK government would have even less money to invest back into the economy. And so the situation could actually get worse due to political decisions rather than economic decisions. So the overall summary of today's video is that the UK, along with Japan, is now officially in recession, and it's unlikely that it's going to get itself out of that situation at any time in the near future because it's still focused on bringing inflation down. Even though it's down to 4%, it's not at 2%, which is where the Bank of England wants it. And so interest rates are likely to remain high. That is depressing the level of spending, both for companies and individuals in the economy. And until that's sorted out, we won't see the UK economy bouncing back anytime soon. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.